All right, video number 2. This time we're talking about donor advised funds, DAFs. My name is Duncan Kelm. I am an enrolled agent and the owner of Arrow Point Tax Services. We focus on forward-looking tax planning for our clients and look to try and minimize taxation as much as possible. So today we're talking about donor advised funds. And before I do that, I should mention this is not explicit tax advice. You should consult a tax professional before implementing any of these. This is not investment advice or investment related in any way. Be happy to have a follow-up conversation with anybody who's interested. Reach out at arrowpointtaxservices.com. Okay, so first off, what is a donor advised fund? It is basically a fund that allows charitably minded people to front load tax deductions. So if somebody's giving $10,000 a year for the next 10 years, they can take that deduction in each year, and the deductions laws change. We saw that with Tax Cuts and Jobs Act. It's happened actually in a micro way with the CARES Act that passed earlier this year in response to COVID. So it changes all the time. What a donor advised fund allows you to do is squeeze all those donations forward into 1 year. So you want to couple it with big earning years, selling a business, something like that, selling a real estate piece of property, where you're going to have a high tax exposure. You want to couple it as long as you're itemizing, and most of the time people who would do a donor advised fund tend to itemize. So you can find the definition of it under IRS code 4966D2 if anybody's interested in looking up what it actually says. Basically, again, what the strategy allows is to accordion donations into a single year to help offset some income. So generally, and it depends on some nuances, but generally contributions to a donor advised fund are considered contributions to a public charity. So as long as the donor advised fund is going to meet certain qualifications, and there's tons of companies out there that do this, and they basically have to operate as trustee, fiduciary. Their reputation is at stake that they have to follow these guidelines. You get a 30% or a 50% deduction. And it's pretty great because you can offset that as an itemized deduction against your adjusted gross income. So what's 50%? What's 30%? If you were to contribute cash, so say Mr. Jones gives $10,000 a year and has in the past, and chooses in 2021, I'm going to gift $100,000 and I'm going to do it through a donor advised fund. If he gifts cash, he's going to get a 50% itemized deduction based on that 100,000. So rather than the 10,000, 50%, 5,000 deduction annually, tax code changes. We've seen that obviously in recent years with Tax Cuts and Jobs Act, CARES Act, and such. He is going to get a $5,000 deduction a year. Or through a donor advised fund, it would be $50,000 in the year he funded the DAF. Conversely, if he was to gift property, appreciated stock, generally these tend to hold more liquid assets. So appreciated stock and securities is a really good example. You would get credit at 30%. So you donate $100,000, it would be a 30% deduction in the year that you made the contribution. You can actually choose to fund it lump sum. You can do it periodically, ad hoc. You could even technically choose to do it every year. There's no real purpose to do a donor advised fund if you're doing it every year. It'd be better just to go direct to the charity. It saves you on cost and such. So the real benefit of a donor advised fund is, one, if somebody knows that they're going to be charitably minded over a long period of time, the funds themselves can be invested, they can grow, and that growth is tax-free. As long as it's being distributed to a charity, that growth is tax-free. So I like examples, so let's use a quick example. Mr. Smith gives to Red Cross every year. He gives $10,000 a year. In order for him to gift $10,000 a year, unless he's doing something out of a retirement account, which we won't dive into detail of that right now, he has to make after tax $10,000 a year to get that over to the Red Cross. Whereas if Mr. Smith were to take that $10,000, or let's call it he's able to contribute $50,000, 5 years worth of his giving plan, and that is invested over the preceding 5 years, whatever that grows to, whether it's in CDs or whatever investments, that growth is tax-free and can be given to charity. Whereas if Mr. Smith were to do $10,000 and the other $40,000 invested, he would have capital gains. He would not have the same amount of dollars as if it was sitting in this type of account that is tax advantage. So from that perspective, it's a really good vehicle when you know you're going to be giving and you have planned giving goals or objectives as a family or as an individual to do this. Once a grant is made to a donor advised fund, this is one of the big issues here, you no longer have ownership. So you are foregoing ownership of these assets in order to receive that deduction in the year that you gift the assets to the donor advised fund. Now, almost every donor advised fund consults whoever is the donor. They say, what are you thinking this year? You can call out before you set up the fund, hey, these are the charities I'm interested in, I gift to historically. Technically, you can't direct where those funds go. But again, these companies that run these donor advised funds, they're in the business of growing and adding business. So they're going to send 99% of the time, as long as it's a qualified 501c3, public or private, they're going to send those funds based on where the donor wants. So you receive the tax benefits, the funds get to the charity of your choosing. And actually, if you think about it, it might even benefit them more because a dollar today in general with inflation tends to be worth more than dollars in the future. So $50,000 today is actually a higher purchasing power than $10,000 over 5 years. So from that perspective, that's getting into the weeds on discounted cash flows and all sorts of stuff. But it actually makes sense that $50,000 today is worth more. So in general, grantors are consulted over the life of the funds. Each year they'd say, Red Cross again, sir, yes, okay, send it. And if you add more, they could say, okay, would you like to make a change? Someone could say, yes, I've sent to 2 charities in the past, I'd like to add 2 or 3 more. And again, that qualification metric is really the 501c3. Donor advised funds are not required to distribute, as I understand it. However, all the grants must be made to charities in good standing with the IRS. So you can't give to a charity that's literally set up to basically feed your own pocket or benefit. So IRC 4941, self-dealing, you cannot use a donor advised fund or even a charitable contribution, for that matter, that is going to benefit you personally. So you can't set up your own 501c3 that basically pays for Mr. Smith's vehicle or something like that and somehow mask it as a charity. You're going to be in big, big trouble with the IRS if you do that. IRC 4942, annual payout requirements likely apply. In most cases, they do apply. To assign this tax benefit, and it's a big tax benefit, they want to make sure that the funds aren't just sitting there and they're actually going to the charities. So in most cases, you will almost always have some sort of distribution requirement. The real way to think about a donor advised fund is basically a charity savings. So you have a health savings account for healthcare and health expenses. A donor advised fund for people that are charitably minded is really a savings mechanism and a great tax advantage savings mechanism for how to gift and give. So these are my notes here. I reference a couple tax cases that have overseen and reviewed donor advised funds. So National Foundation Inc. versus United States 13 case, they found that the distributions from a donor advised fund would qualify as a charity. Back on the self-dealings, the New Dynamics Found versus United States. Basically, the case found that because the funds were used for personal interest, it eliminated the benefit of essentially it pierced the benefit of the charity, and there were big tax consequences. So that's pretty much it. You can couple this with something called a charitable leads trust. That can be pretty powerful. You'd want to compare it with something called qualified charitable distribution. If you're retirement age and you are charitably minded, you can actually direct retirement required distributions directly to a charity. So you kind of want to do an analysis to see which gives the better tax benefit. And again, this is great to couple with big income years. So hope that was helpful. Please leave a comment if you have any comments. arrowpointtaxes.com is the website. Please reach out if you have further questions, and thanks for watching.